Hello everyone, welcome to the next video in Ariel FX's Mastering Your Psychology course. And in this video, we will be discussing psychology in risk management and position sizing, probably one of the most crucial topics and most overlooked concepts within the area of psychology that really kill many of the traders out there. Probably one of the biggest killers in people blowing their accounts and losing in the Forex market is not being able to control their emotions when it comes down to risk management. They oftentimes over leverage and eventually blow their account in doing so. So as we go, you will get a very large and in-depth glimpse as to how we can better position our risk so that we can continue to trading for the next day and not having to ever worry about blowing an account ever again. What the major problems are that people may not even know that they have, and the actual solutions that you can start applying in your everyday trading today. All right. So the first, I want to talk about the retail mindset. What does everyone think of when it comes down to risk management? Well, first and foremost, we have to understand the mentality of a retail trader, and that is the get rich quick mentality. Everyone thinks that if I start trading, I can follow every single one of those fake gurus and become just like them in a matter of weeks. The get rich quick, the make $1 million overnight, that's what they want to do. They have that instant gratification feel. They do not understand what it is to delay their own gratification. They see someone making $10,000 of profit, they instantly think that they can do that no matter what their account size is, no matter how much of a level of experience they have, not having a clear understanding of their actual strategy to begin with. They just want to get rich as fast as they can because either that's just their mindset and they have that instant gratification mindset, or they're being influenced by people on social media, maybe their friends or family who are doing quite well in trading, and they think that they can do the same in a tenth or a hundredth of the amount of time that they have. Also, the issue of fake gurus, guys, Forex is swarmed with fake gurus, fake people not having any understanding of how trading actually works, but trying to sell you the fake dream and the false hope of becoming very wealthy in trading. Now, it is definitely very possible to, but it takes quite a long time to be able to understand how the market works, put in the experience, put in the time, put in the focus and the energy into making it work for you without having to fake profits, fake lifestyle, fake entries, fake trades. Just about 90% or 95% of all the Forex content on social media is fake. They have to fake their lot size, they have to fake their account, they have to drive these fake cars that they probably just borrow from other people just to create YouTube videos and all the other baloney. It's selling you a lifestyle that is unrealistic to a beginner trader. And as you are taking this course, think about how many years of trading you have under your belt. Or not even that. Think about how profitable you are in the Forex market. All right. So after thinking about that, you can't do what all the other fake people on social media are doing. They're providing you with this false hope, thinking that they can take you to whatever level of experience, to this driving a Lambo type of lifestyle within a matter of months if you follow their signals. First of all, signals don't work. Second of all, it's just not realistic. So they're pumping a lifestyle to try to sell you on a product that they probably are selling, and that's where they're receiving most of their income. Next, unrealistic expectations. A lot of retail traders think that 5, 10, 15, 20% per month is really good. In all reality, if you can do 5 to 10% a month, that is a very good return and quite a realistic return for someone who has a relatively high win rate and can produce high risk to reward trades. But when someone comes along wanting to make 50% or even a 100% flip of their account, that is very unrealistic. We have to think about the professional traders. Who is actually making the money? Professional traders, hedge funds, institutions. Do you think that those hedge funds out there, if they have a Forex or maybe some sort of securities type of trading account as a part of their overall fund, do you think that they're taking 5, 10, 20% risk per trade? Absolutely not, because they know it is not sustainable, it is very unprofessional, and that is how you lose money. Yes, I've seen people flip their account, but the problem with doing that is that creates the habit in your mind to say, hey, oh, I've done it once, I can do it again. In all reality, you can do it again, but if you consistently try to do this in the long term, you are going to fail. You are going to blow your account, and you're going to have to continue to restart the whole cycle of funding your account, trying to over leverage and flip it, to then blowing your account and starting all over again. It's a constant cycle. That's why so many people say, oh, I've been trading for 1, 2, 3, 4, 5 years and still aren't profitable. It's because you're not developing the right habits when it comes down to not only risk management, but trading in general. So they set these unrealistic expectations. A proper expectation for a percent return goal per month is probably anywhere between 3 to 5, maybe 6, 7% per month. Using good risk management, knowing that you're not going to be profitable every single month, but on average, if you can do that per month, you are outpacing inflation, you are beating the S&P, you are performing better than many other hedge funds out there. Think about it. Even 2% per month, 2% is 24% per year. The average hedge fund in 2021, thinking 10 years before, 2021 did, I believe, 10.3%. I think that was up from 2020. This year, they're expected to do about 11.5, I believe, if my numbers are correct from that source. So understanding that they only are looking to get 10 to maybe 15% if you are a consistently profitable hedge fund, which not many of them are. That is a phenomenal return because that is compounded over time. Go to a compound calculator on Google and type in some numbers and play around with it. You're going to be surprised as to the amount of money you can make through compound interest. And I'm going to tell you, compound interest is very, very real. But people are so used to that instant gratification and wanting 20%, 30% return per month, not having any understanding of how risk works and the realistic expectations you should be setting yourself. Even realistic expectations can make you very wealthy over time. And it all ties back to that instant gratification. Are you willing to delay gratification, not make $1 million overnight, and make $1 million over the course of the next few years, maybe 10 years down the road, after you've had the experience and can compound your money over time? That's the difference. Impatience. So going back, people are so impatient. They want to flip their account. They want to make 10%, 20%, 30% per month. So they're very impatient when it comes to their trades. Many people out there, and I would probably say 90 to 99% of all traders out there probably have an account nowhere more, not more than about $1,000 in their own account of their own capital. If you use 1% risk per trade, which is the top of the line, probably the highest percent risk you should probably be using per trade, on $1,000 account, that is $10, right? Obviously 10% is 100, so 1% would be $10. So if you're risking $10 and you have, let's say, a 1 to 3 risk to reward, that's $30 profit. On a $1,000 account, I don't think anyone wants to make $30. Even though that's a great percent return, people think $30, oh, that's terrible. I can be making $100 per trade, $500 per trade. Okay, well, take that and go on $1 million. What's 1% of a million? 10,000. Same risk to reward, 1 to 3. You're making 30K per trade. So it's all in the mindset of a numerical value instead of a percentage. And this is what leads to pips versus percentages, which is my last bullet point. Everyone thinks, or I wouldn't say everyone, but most people think that it's the pips is that what makes you money. If you think it's the pips that make you money, you have no concept of risk management. That is just a fact. It is a straight fact because you're thinking that, oh, well, if I just increase my lot size and I have more pips, then I'm going to be making more money. Well, if you're increasing your lot size for the same amount of pips that you have, that means you're not even taking into consideration the amount of pips and stop loss that you have based upon a percent risk of your overall account balance. So that just tells me you have no idea of risk management, as I just said before. What really makes you money is percentages. 1% of $100 is $1. Is that more than 1% of $10,000? It's the same percent return, but it's just a higher numerical or dollar value, right? So that is why if you do 1% on 100, you're only making $1. But if you're doing 1% on $100,000, you're making $1,000. It's the same percent, and you're taking the same trades, the same risk to rewards. You're just basing it upon percentages, which is what's keeping you in the game because you're not over leveraging if you're using percentages to calculate your risk rather than pips. That's why it's always good to increase your capital over time in your account slowly, because if you're risking the same over time when you grow your account, those same percentages are going to increase your numerical or dollar value of your account. That's just how numbers work in regards to finance and trading and investing. All right, so think about it in terms of percentages. Have an example for you. Your account size is $10,000. You risk 1% per trade. That's $100. 250 pip take profit, 50 pip stop loss. Many people think, oh, 50 pips, that's way too much. I don't want that for a stop loss. That's a 1 to 5 risk to reward. So in all reality, you should be using a 0.2 lot size. Many people would look at that as, oh, I have $10,000 in an account. I'm going to use 5 lots. But 1% risk for your 50 pip stop loss is a 0.2. $2 a pip times 50 pips equals 100. 1% of 10,000 is $100. Let's go to the right side here. Account size, same, $10,000. Risk is the same, 1%. Now in this case, you have a lower amount of a pip take profit. In the first example, it was 250, and now you only have 100, right? But your stop loss is lower, is 20 pips, but it's still the same risk to reward. So in this case, you would use a 0.5 lot size. So $5 a pip times 20 pips, that's your stop loss is $100. Still the same as 1% of 10,000. So that's still 5% of your account if you hit that trade. Both of them are 5%. But the one that has more pips does not make more money. In this example, they make the same. Now let's take that and let's just say it's 10 pip stop loss with 100 pip take profit. Now that's a 1 to 10 risk to reward. Now the person on the right may double the amount as the person on the left, even though the person on the right had less pip return than the person on the left. That is why pips do not matter. Percentages are the only ones that matter. So as we understand percentages, we can start calculating risk properly and forget about over leveraging so we can use proper risk management. Lack of knowledge. This is a big thing. Many people don't understand risk management. It's a lack of risk management education. No one was ever taught risk management because it wasn't a part of the strategy. Many people go on YouTube or take courses and all they talk about is the strategy at hand, but when it comes down to actually placing the trade, they have no concept or no understanding of how to properly go about placing that position. You may know exactly where to place your entry just based upon the strategy at hand, but when it comes down to actually placing the position size for your trade, at what position size do you place? And that's all dependent upon your risk percentage. It's all dependent upon how many pips your stop loss is, and it's all dependent upon the currency pair and the account size that you have. So having that understanding, we can develop a very good habit of placing the correct position size for the trade that we have. Next bullet point is prop firms produce bad habits. This is why I don't like prop firms when it comes to beginners trying to trade, because first and foremost, they try to just hop right into prop firms thinking that, oh, well, I'm just going to start because I can get a $100,000 funded account and I can make thousands of dollars per month. Well, if you have no idea on how risk management works, or you have no experience in the market and you're not profitable, what makes you think you're going to pass that prop firm to begin with? The chances are so low. This is why prop firms make millions and millions of dollars from you, is because so many people, about I think 95 or 96% of those, fail their first go around. And then their evaluation phase, about 90% of those people fail that. And about 90% of those people don't even make it past their first withdrawal. This is how prop firms make so much money. But they're telling you, hey, you need to do 10% return in an entire month without 5% daily max drawdown or 10% overall drawdown. It doesn't produce the realistic expectations that you should have in terms of risk management and in terms of proper position sizing for your trade, because you're so worried about hitting that 10% per month, when in all reality, about 3 to 5% per month is a phenomenal return. But it all depends on risk management. If you have trades, just like I've had them in the past, that have huge risk to rewards, and I win a lot of them, then yeah, I could easily make 10, 20, 30, 40, 50% in a month. And I've had months like that. But my risk isn't aiming to hit that 50% return per month. I just so happen to do that because I went on a huge winning streak and I have high risk to rewards. So using proper risk management, you can still make that amount of money, even though it's not going to be consistent over time. You're not going to consistently hit 50%, which is an amazing return, but you have to focus on the risk management side first. And if your risk management is on par and you're hitting those returns, then you're doing something right. But you shouldn't formulate your risk management around trying to hit a certain percent return goal, because that is what's going to screw you over. So prop firms create that bad habit of having people over leverage and having people, use the wrong position size when it comes to trades, because they don't teach them this stuff, because they want you to blow your account, because then they can take your money that you used to pay for the challenge. That's how this business is run with prop firms. Okay, they always have the advantage. Understanding percentages, we kind of just went through that in the prior slide. Stop loss and position sizing. We want to use the position size calculator. This is what I've grown up using. It is the easiest little tool that you can have and use in regards to Forex position sizing. All you have to do is go to position size calculator. The link is on the next screen right in here with the exercise that we're going to do. But in what we can kind of just go over this now. Go to position size calculator. It's on Google, My FX book. Position size calculator should pop up with the first one. What you'll simply do is type in the currency pair that you're trading. Let's just say it's Euro USD. You type in your account currency. So for me, I'm in the United States. I use USD. That's my account currency. Let's say the account size. I'm going to be realistic here and say maybe a couple of you, account size is $1,000. Okay, let's just throw that out there. Risk percentage or risk ratio, which you have there. Type in 1% or a 0.5% or a 1/4%. You don't want to be risking more than 1%. Stop loss in pips, that just depends on your trade. Let's just say the stop loss is like 27 pips or maybe 28.5 pips. Could be anything. After you've typed all that information in, keep that trade size lots equal to 1 and then click calculate, and it'll say results and it'll say sizing, and it will give you the exact lot size to use for that particular trade to keep your risk management the same every single time. If you use risk management, you shouldn't worry about losing trades. You shouldn't be worried about getting into trades that you've over leveraged on and being psychologically, emotionally attached to them because you're over leveraged, and then you make irrational decisions as a result. So having that lack of knowledge and not being able to properly have the risk management that you need can lead to so many other problems in the future. Over leveraging. So this is sort of what we've been talking about. What is it and why does it happen? Over leveraging is simply when someone takes a position that's abnormally different or abnormally more than what their account balance is saying, right? You don't want to use 10 standard lots on a $1,000 account. You probably won't be able to, but if you did, you could blow your account in a matter of seconds. That's over leveraging, trying to make a ridiculous amount of return based upon the account balance that you have in your account. The catastrophic implications of over leveraging. So when you over leverage, this leads to a lot of different problems. Not only can it lead to blown accounts, but let's just say you didn't blow your account. Let's just say you're in the trade. As you are over leveraging, you become so psychologically, emotionally attached to it because if any drawdown occurs whatsoever, you're seeing that balance decrease exponentially. It's growing very, very quickly, which leads to you, pulling positions out of the market early when you shouldn't have. Maybe adding a position to try to hedge the position that's in a loss. Maybe taking profit too early, moving stop loss to prevent it from hitting your stop loss, right? Because you don't want to lose that amount of return or that amount of loss, right? So these are just the subsections or the indirect or secondary implications that over leveraging can have on you, and especially your psychology. There's so many others as well. But in terms of amateur versus professional, the standard for risk. Now, we first have to understand what the amateur trader does in terms of risk. I bet a lot of you out there probably trade with risk above 1% per trade. And I've been the victim of that before, back in the past when I was unprofitable. I was, years and years ago, I was risking 2, 3, 4, 5% risk per trade. Was using risk that I wasn't even consistent with. One day I was feeling good, I was risking 5%. One day I wasn't feeling too good, I would risk 2%. You need to keep your risk the same because if you understand numbers and statistics, if you keep every variable the same, you have the higher probable chance of succeeding. When one is going crazy and then The other one is going in the opposite direction, meaning if one trade is 5% risk and the next is 2%, well, what if you lose on the 5% and then win on the second 2% risk, right? You're still net in a loss, but yet you've had a 50% win rate. So this is why it's so important to keep your risk the same. A professional will risk no more than 1%, depending on the account size, probably more along the lines of, a 1/4% to maybe 0.5%. I have never used 1% per trade since like 3 or 4 years ago when I first started. I haven't because there's no need to. I can still make 10, 20, 30% per month on a good month using 1% risk. There's no need to over leverage. It just leads to so many other, again, catastrophic implications. So I would say the standard for amateurs is probably anywhere between 1 to 5% per trade, probably even more, to be honest with you, if they're trying to flip their account. But professionals, anywhere between 1/4% and maybe 1% at most. The need for consistency. It's very important to be consistent. Just like I said before, it's so important to be consistent because if you're risking 5% on one trade, 4 on the next, 1 on the next, it's just going to mess with the numbers. Your win percentage, or the amount of trades that you win every like 10 trades or every 100 trades, it's going to need to go up over time because you're using inconsistent risk. Because eventually you're going to lose, or most of the time you will lose with those big, heavy trades when you're risking a lot because you're more emotionally attached to them, creating very irrational decisions than the ones that you have lower risk on. So over time, it's just going to cause problems for you, and you're going to be required to make or hit more of your take profits than if you were consistent. So be very consistent. That's how you can overcome it. Understand what professionals are doing in terms of risk management, and it's okay. Forego the instant gratification. Forego not making 100, 200, 300,000 in one trade. Even if you're only making like 5, 10, 15, 20 bucks per trade, if you have a low account size and you're using good risk management, my hat's off to you because you're doing it the right way. You're building that habit and you're setting yourself up for more success later on. Okay, what if I told you right now that you could be a 6-figure trader and making 6-figure income in less than 2 years? Many people would say, oh, well, you're lying. No way. It's possible for really only one reason, only one way. One, you forego all of the instant gratification. You're not blowing your account because you're not over leveraging. You're not trying to flip your account. You're using really, really good risk management on a very small account to gain the experience. You're not trying to go for a prop firm right now because if you're not consistent, then there's no point of purchasing one because you're only going to be gambling, right? So those people who can forego the instant gratification to have a small live account, because that's, it helps psychologically, using good risk management, not even worrying about the money, worrying about the knowledge and the experience, and not caring that maybe you're only making like 50 bucks a month from it, when in all reality, you're gaining so much more experience than everyone else that you can take those skills later on and then apply it to a larger account size. And now you're already set up for success that you can now trade that account size. So starting off slow, delaying the gratification, understanding trading as a process, making sure you're using consistent risk management across the board. And once you become consistently profitable for at least 3 to 6 months, then go for that prop firm. So you've already developed those skills over the course of like a 12-month, let's say a year's time, right? And then, after a year's time, you're seeing consistency. Wait another 3, 4, 5, 6 months, maybe even a little bit longer to prove to yourself that you are consistent. After that, it's probably about a year and a half, maybe 2 years, then go for your prop firm challenge, having the understanding that you've already built the correct habits to begin with, but at the same time, have not lost money in the process because you're not trying to flip your account and not over leveraging. You're using consistent risk management. You're building the habit. You're delaying gratification. Now you have all the necessary skills in order to apply that to a real prop firm in which you have a higher chance to succeed with. You have a 100 grand account prop firm challenge. You make 5, 10% per month, which is still on the heavy side. But if you can do it, maybe let's start off with 3 to 5%. That's $3,000 to $5,000 per month. You maybe become more consistent. You increase your win rate because you have more experience, and then you increase your risk to rewards because you can fine tune your entries. then you could be making probably on a good month, maybe 10, 15% on a good month. Don't think of that as the standard, but people can do that on occasion. So 10% is 100 grand, even if you're doing like maybe 8%. 8% is $8,000 times 12 months. That's $96,000. That's just below six figures. And you've done it the right way, and it's taken you about 2 years to do. Does that not beat working 40 years of your life with a 9 to 5? See, this is how I teach my clients to approach trading. And then after they've been rooted in that education, then we can really, really hit home on the strategy, get them a part of those skills, and really work on those skills. Now you're not only set up from a or a technical standpoint in terms of the strategy, but now you're psychologically like ready to trade, and you have the indirect trading knowledge to be consistent. Revenge trading. What is it? Why does it happen? Especially when you're over leveraging and not using good risk management, you tend to revenge trade. Now, what revenge trading simply means is that when you're losing a trade or have a series of losses, you trade irrationally and without rules or trading plans because you're so scared of losing that money. You want to make that money back because you can't stand yourself being in a loss. So you place these random positions because you're mad at the market and you think that you have to always be profitable and you can never take a loss on your chin and move on. You always have to be making money. And that leads to revenge trading, and that leads to deviating from your rules. That leads to, not following your trading plan and just making irrational decisions when it comes down to your trades, not having the confluences that you need for that particular trade. And that's when it leads to even more and more losses. It just exponentially rolls. So we need to be trading each trade individually from one another, understanding that losses are a part of the process, especially when you're beginning. If you're a more seasoned trader, you would know it is impossible to win 100% of your trades. Even the best traders in the world probably have 50, 60% win rates. But doing that with high risk rewards, they compound their money over time, they're multimillionaires. That's the reality. So you don't win every trade. It's not that you can win every trade. You can't win every trade. You cannot. It is impossible to do. Right? So having that understanding, you can sit back and relax and be, okay, I lost this trade. There is no other setup. Let me move on, because there is only going to be negative consequences with you letting your emotions get to you when it comes down to losing trades. It goes back to instant gratification, right? You have the instant gratification and you really want to just be making money right off the bat. So when you lose, you revenge trade to try to make that money back because you just want to make money and not even caring about risk management, not even caring about following your rules, the fundamentals of investing, the fundamentals of trading. You're not even following the fundamentals. You don't go out there playing football not having any understanding of fundamentals. You would get run over. You would get ejected, probably because you're doing something stupid, right? You have no idea. That's why you have to root yourself in the fundamentals first, and then the trading will take care of itself. Psychology is about 80% of trading, and then 20% is your strategy, right? So eliminate the instant gratification, eliminate the anger and fear that comes with revenge trading, right? Many people are greedy and they want to make that money back, so they place random trades. Many people get angry. I've been there before years ago. I used to get angry at the trades that I lost on, and then I would go and try to trade something to try to make that money back. Next one is fear and shame. You feel shameful because you didn't win a trade, so you want to make that money back. You feel like you're letting someone down, maybe your friend or a family member, that's depending upon you. Maybe you feel shame for yourself, as in, why can't I do better? Why am I losing this? Then you try to prove to yourself that you are a good trader, because in the back of your mind, you don't want to think of yourself as this loser, even though you're not a loser. If you lose a trade, you are not at all, right? It just didn't happen for you that day. Move on to the next and be a winner the next day. People are so scared and fearful for losing that they have to try to make that money back over and over and over again. And it just leads to that cycle of losing money over time. So how can you overcome this? Well, first and foremost, your risk management needs to be on par, because having that understanding that if your risk management isn't where it needs to be, it leads to the psychological negative consequences when it comes down to over leveraging or being overexposed in the market. So that creates that psychology or emotional attachment, or that higher, stronger emotional attachment for that particular trade. So the way to overcome that is, first and foremost, use good risk management, number one. And it's so overlooked. And I know it's such an easy thing to say, but the question is, are you doing it? Are you actually using good risk management every single time? If the answer is no, you need to fix that. And there's your problem. If the answer is yes, then you're already on the right track. And now let's continue. For revenge trading, treat each trade individually from one another. Okay. Each trade should have its own confluences. You should be following all of your rules and your entire trading plan to a T for every single solitary trade. Those two are the biggest things that you need to do to eliminate revenge trading in your life. Also, understanding that trading is a process, knowing that you will lose on occasion. That eliminates any greed or anger, fear, and shame that you may have, because it is a part of trading. It's not you who's a bad person or a bad trader maybe, or just, that you should feel shameful for because everyone else is doing well. No, even the professionals are losing trades. Heck, even hedge funds and institutions lose trades. They do. So having that understanding and taking that step back and calming down when you lose a trade, then you're well prepared to take on the next one, right? Over trading. So this kind of ties into everything we've talked about as well. What is it and how does it happen? Over trading is when you're maybe following your rules, but your rules are so very surface level and not in depth, and not having an understanding of the strategy, that you're placing way too many trades than you should. If you see a double top or a double bottom and you wait for a breakout, well, that's a really terrible strategy, but let's just say that was it. Then you're probably seeing that 10, 20, 30, 40 times a day, because it happens so many times, right? So when you're over trading, it's just you're becoming more overexposed to the market, and you're more apt to lose more, because if we know that everything that goes with trading, most people lose. If you're trading more, you're probably losing more. But let's just say you have a great strategy and you're over trading. Well, what does that lead to? That still leads to you having that psychological, emotional attachment to all of those trades. So you're trying to close all those trades in a profit, because you don't want to lose any individual ones. And so what that does is that eliminates any potential risk to reward that you have. Because if you see a trade hit stop loss, you're like, oh, well, the other ones that are in profit, I better close those to hedge my other losses. When in all reality, you're not treating each trade individually from one another. Lack of preparation. Do you even know your strategy? So many people go into trading and then they don't even know what they're doing. You have to prepare your trading, prepare your trades, develop a trading plan, which we'll go over later on in this course. Develop your set of rules, understand how to approach the market every single time, so you know that you're not going to over leverage, you're not going to revenge trade, and you're not going to over trade. Lack of preparation. Again, do you have a plan? Do you have a plan? So this comes down to having that trading plan and being prepared to enter into the market every single day. So when you come ready and prepared to tackle the market every single day, you're going to eliminate all of those other problems that you were facing before. So the lack of preparation is what is going to kill you. If you don't know what you're doing in terms of strategy, or don't know what you're doing in terms of your trading plan and how you're approaching your risk management and approaching each individual trade, then it's just going to have that cycle of, you're not preparing yourself. That leads to, you're doing what you want every single day in trading. When people do what they want, their psychology and their emotions go berserk. And that's what leads to so many other problems in trading. The result of unrealistic return goals. So if you are wanting to hit, let's say 15% or 10% per month, and let's say maybe you're on the last day of trading and you're only hit 5%. Well, your goal was 10%. So you try to overtrade and try to compensate for the lack of return that you were getting. So now understanding that 5% is in all reality a very good return, you haven't hit your goals yet, so you have to overtrade and not follow your trading plan just to get those trades on to try to make even more money. So by the end of the month, you will hit that return goal. So understanding that, again, going back to trading each trade individually, if it comes down to a time where maybe you're even in a loss for the month and it's the last day of the month, and maybe you have a chance to go break even, If there is no setup to take, don't take it, because it just leads to you not following your rules, to potentially over trading and placing as many trades as you can to maybe try to get that profit to where it needs to be. Revenge trading, you haven't been making a lot of money. Maybe you're in a loss. Maybe you're even break even or not used to not making a lot. So you revenge trade to try to get that percent return up to where it needs to be in your mind. Also, over leveraging. You are, you may be like a couple of percent away from hitting your goal. Then you try to over leverage so that one trade may get you to that level. Or maybe you're on a prop firm challenge and you only have 1 day left and you have to hit 10%, but you're sitting at 4%. So you risk like 5% in that particular trade. Even though you may hit that trade and it will win, oftentimes you won't hit that trade and you will lose, right? Because maybe your risk to reward is great, but your win rate is not as high. So you have a higher probable chance that you will lose that trade and then lose that 5% that you over leveraged on. When in all reality, if you are consistent with your risk management and having high risk rewards, then you're going to be overall profitable. You don't need to over leverage. So that just comes down to that prop firms, creating that bad habit of over leveraging. So many people try to pass it within a day. So many people try to pass it, within a week. And maybe if you're so close to being there and it's the last day, you over leverage to try to hit that percent return. But that over time subconsciously, creates that feeling that, oh, I have to overtrade when I haven't hit a goal, or I have to over leverage when I haven't hit this return, or I have to do this, I have to do that. It just subconsciously trains your brain to do the wrong thing. So how can we overcome this? So again, going back to, it all ties together, guys, if you haven't noticed. Risk management, so key, right? You have to be able to have your correct position size per trade, knowing that you're not risking more than 1% per trade. Risk management on par every single time. You're not over leveraging. Two, revenge trading. You overcome over trading by doing all the other things correctly. You don't have to trade unrealistic amounts of trades because you're using proper risk management so you can maintain that emotion and psychology. But at the same time, you're not having to revenge trade any losses or revenge trade to try to win anything back because you're following your plan and you're prepared to enter the trading day, very, very much prepared. So you're not having to overtrade. So setting those unrealistic return goals just feeds into the overall problem. So to really overcome it, you need to first understand your strategy. Build a strategy that's involved or kind of cycles around, deep confluences. The more confluences you have, the better your plan is, the better your trade is going to be, the higher probable chance that that trade will succeed. So it comes down to, first of all, planning, but two, understanding that the more trades doesn't mean more profits at all. Over trading does not mean over profiting. It actually probably leads to over losing, especially when you're a beginner trader or maybe an intermediate trader, not yet a pro trader yet. All right, so the exercise that we can have here is I want you guys to go to my FX book, familiarize yourself with the basic layout and entry format for calculating risk. Many of you have already done that. If you have, great. If you haven't, which I'm sure a lot of you haven't because I'm sure a lot of you are still over leveraging today, visit that site, myfxbook.com, position size calculator. It should be the first one that pops up on Google. But honestly, when you finish with this video, sit back and just be honest with yourself. Take a piece of paper out and write down as many challenges you face when it comes to risk management and what are you doing wrong. If you are not over leveraging, then you're already on the right track. But if you find yourself not using proper risk management, for what reason is that? Is it because you want to, make a unrealistic return? Is it because you want to pass a challenge? Is it because you have lost a couple trades and you want to revenge trade those and over leverage to try to make that money back? Is it because you don't want to let family or friends down? Is it because, it could be for whatever reason. Write down as many challenges that you face when it comes to risk management. What do you see yourself doing on a day-to-day basis? Kind of break into your mind and write down as many things or as many challenges that you have faced. And once you are done with that, come to me with those challenges and show me. and then I can see those and provide solutions and help you realize maybe what you're doing wrong, that maybe you don't know that you're actually doing them wrong, and then I can help you along with that. So it's not just an exercise for you, but it's an exercise for you to do, but then show us when you're finished so that we can help you and set you up on the right track. So based upon what you have written above, write down ways in which you think that you can combat these issues to help you become a risk management connoisseur. So, in order to master risk management, to be a professional risk management trader, if you will, kind of a joke there, but based upon what you've written down, come up with ways based upon this video that you have learned from, and write down the ways in which you think you can combat these issues. Again, present this information to us, and we will help you add to that list, maybe take away from that list, or just change things up a little bit to make sure you're on the right track. And last but not least, hold yourself accountable. And this is more of a rhetorical question. This is not meant to have an answer, but only you can have this answer in the back of your mind. Are you putting these solutions into practice? Are you doing what is necessary to become that professional trader and not following the herd and being sheep for what everyone else is doing? If you're practicing the same practices that everyone else is doing, there's something wrong going on. All right, so just in the back of your mind, think about it to yourself. Are you actually doing what is necessary? Are you putting these solutions that you have written down above based upon this exercise, are you going to be putting them into practice? Are you putting them into practice, and will you? Are you willing to? That's the biggest thing, is telling yourself that you're willing to do something and then changing it. All right, guys, thank you guys so much for listening to video 2 of the psychology course, Mastering Your Psychology, and stay tuned for video 3.